All right, let's talk about Bristol Myers Squibb. They're one of the world's absolute pharmaceutical giants, but right now they're facing a challenge that could literally sink most companies. Their response, though, is one of the boldest corporate turnarounds you'll ever see, and today we're going to break down exactly how they're pulling it off.
Okay, so let's just frame this up right away with the big question. Imagine you're the CEO and you're looking at a future where over 30 times billion dollars of your yearly revenue is about to just disappear. What do? I mean, that's not some thought experiment. That is the very real situation Bristol Myers Squibb has been staring down.
And this, right here, is the heart of the entire story. It's a tale of two portfolios. On one side, you have the pillars of the past, these blockbuster drugs that built an empire, but now they're losing their patent protection. And on the other side, you've got a whole new lineup of medicines just rocketing upwards, designed to carry the company into the future. It's a genuine race against time. Can the new stuff grow fast enough to outrun the decay of the old?
So let's really get into this. It's like a tale of two completely different companies living under one roof. You know, to really grasp the size of this problem, you have to understand the size of the company itself. Bristol Myers Squibb, or BMY as we'll call it, isn't just some drug maker. We're talking about a titan in the fight against cancer, immune disorders, heart disease. They're known for science that truly changes people's lives.
But even for a titan like BMY, a massive storm has been gathering on the horizon. And that brings us to the core of their big challenge, something called the patent cliff.
Now, for anyone who's not deep in the pharma world, a patent cliff is, well, it's pretty much exactly what it sounds like. A drug gets patent protection for years, right? That means only one company can sell it. But once that patent expires, boom, cheaper generic versions flood the market, prices crash, and sales just fall right off a cliff. And for BMY, we are not talking about a small dip. The potential revenue at risk is over $30 billion. Just think about that number. That is a massive, gaping hole to fill, the kind of figure that would threaten the very existence of most companies out there.
And look, these aren't just minor products. We're talking about the absolute heavyweights of their portfolio. Revlimid, a cornerstone cancer therapy. Eliquis, one of the most prescribed blood thinners in the world. And Opdivo, a revolutionary drug in immuno-oncology. These are the engines that have powered BMY for years, and they are all heading toward the edge of that cliff.
So, with that $30 billion canyon opening up right in front of you, how in the world do you build a bridge to the other side? Well, that brings us to BMY's master plan, building a brand new, powerful engine for growth. And here's the proof that the plan isn't just a plan, it's actually working. By next year, 2025, that new growth portfolio is expected to make up 55% of the company's total revenue. The shift has already happened. The new engine is officially bigger and more powerful than the old one. So what's in this new portfolio? Well, it's an incredible and diverse lineup. They're finding new uses for their cancer-fighting flagship Opdivo. But they're also launching brand new drugs like Reblozyl for anemia, a breakthrough heart therapy called Camzyos, and even futuristic cell therapies like Breyanzi. This isn't just one big bet, it's a whole bunch of them. Now, this is a really critical point. BMY isn't just trying to invent everything in their own labs. They are also strategically buying innovation. The massive $14 billion purchase of Karuna Therapeutics, for instance, adds a really promising new neuroscience drug. Buying a company called RayzeBio makes them a leader in the fast-growing field of radiopharmaceuticals. They're building and buying their way across the canyon.
Okay, so the new portfolio is already carrying the company, which is fantastic. But that bridge over the $30 billion canyon has to be long and strong, right? So let's look at the pipeline of drugs in development, the stuff that's going to carry them well beyond 2028 when things get really tough.
And man, this pipeline is just packed with potential game changers. In 2026 alone, we're expecting key results for drugs like milvexian, which could be the successor to the blockbuster Eliquis. Plus, there's critical data coming in oncology and even for Alzheimer's disease. These are literally the blockbusters of tomorrow being tested today. You know, this isn't just happening by chance. The company's leadership has put a stake in the ground. The CEO, Christopher Borner, said it himself. Our goal is to launch as many as 10 new medicines by 2030. That is a huge public commitment to just relentless innovation. So, BMY is navigating this massive transition, and they're doing it successfully. But because the market is still so focused on that patent cliff, it's created a really unique financial picture. So let's break down what this means in terms of value and growth. First things first, let's talk income. The company pays a dividend that yields over 4%. Now compare that to the average for the S&P 500, which is hovering around 1.2%. It's not even close. That's a huge return for investors, and it's backed by really strong cash flow, even during all this change.
Okay, next, let's talk about value. To do that, we got to quickly touch on the PE ratio. All it is, really, is a way to compare a company's stock price to how much money it's making. A lower PE can be a sign that a stock is maybe a little cheap compared to its earning power.
And here's where it gets really interesting. BMY's forward PE ratio is sitting at less than 10. That is a significant discount compared to a lot of its big pharma peers. The argument here is that the market is so focused on the risk of the patent cliff that it might not be fully appreciating just how successful this new growth portfolio really is.
So when you pull it all together, you get this really compelling picture. You've got high income from a strong dividend, you've got attractive value because of that low stock price, and you have clear, visible growth coming from both the new portfolio and that packed pipeline. It's a pretty rare combination of stability and serious potential.
Look, at the end of the day, the story of Bristol Myers Squibb is just a masterclass in how to pull off a massive strategic pivot. So as you look at this giant building a bridge to its own future, what stands out the most to you? Is it the steady income from that dividend, the exciting future growth from the pipeline, or the potential value in its current stock price?